Hello, my name is Kenan Elustu, and today we'll be analyzing accounts receivables.
What is an accounts receivable?
Well, a receivable represents a company's claim on the assets of another entity. An accounts receivable is an amount owed by a customer who has purchased the company's good or service. Note: accounts receivables is also known as debtors or trade receivables.
We analyze receivables to understand how efficiently a business manages and collects receivables to avoid bad debt expenses.
One way we can analyze accounts receivables is through horizontal and vertical analysis. The horizontal analysis calculates the percentage change of an account balance. It is measured by having the dollar change over prior year balance. To calculate the percentage change, you take the dollar change of $10,000 and divide the prior year balance of $20,000, then you should get an increase of 50%. This demonstrates that the business is not obtaining all the cash, as money is still owed to them. The vertical analysis is used to compare different financial accounts across the business. It can be calculated either by having the account balance over total assets or the account balance over net sales/revenue. To do a vertical analysis, you could do the account balance over total assets. For accounts receivables for 2018, this is 12.5%, and 2019, this is 25%. Another way to analyze accounts receivables is through ratios. The accounts receivables turnover ratio is used to compare a company's credit sales to its average receivables during that given period. It is measured by having credit sales over average receivables. To calculate the turnover ratio, you have credit sales over average accounts receivables. In this case, it's 2.4 times. This is how many times a business collects its receivables. The days in receivables ratio is an extension of the receivables turnover ratio and is calculated by doing 365 over receivables turnover ratio. Previously, the turnover ratio was 2.4. To calculate the days in receivable ratio, you do 365 over 2.4 to get 152.08 days. The allowance for bad debt ratio compares the allowance of bad debt to gross receivables to determine the percentage of unattainable receivables. It is calculated through allowance for bad debt over gross receivables. To calculate the allowance for bad debt, you do 5,200 over 58,000 plus 5,200, which gives you 8.2%. Thanks.